I want you to try a little mental exercise with me. It's a bit uncomfortable, but just stay with me for a second.
Okay, I'm with you.
You're driving to your office. It's a Tuesday morning. The sun's shining. You've got your coffee. You've got a business you've spent, say, 15, 20 years building. It is your absolute pride and joy.
Right.
You pull up to the gate, reach for your access card, and it doesn't work.
That is immediately a sinking feeling.
It gets worse. A security guard, someone you've never seen before, he steps out.
Oh, no.
He's holding a clipboard, looks at you, and tells you that you're trespassing. Because as of 9:00 a.m. this morning, you don't own the building anymore. In fact, you don't own the company vehicles, and when you try to buy lunch later, your personal bank card is declined.
It sounds like a scene from a financial thriller.
It does, doesn't it? But for a lot of South African business owners, this isn't fiction. This is the reality of a liquidation or a massive legal judgment when you haven't properly ring-fenced your life. You build this amazing castle, but you've built it on a fault line.
And that is exactly what we are unpacking today. We're looking at a concept our sources call the asset protection fortress. It's a strategy to stop that exact Tuesday morning nightmare from ever happening.
We have a really interesting stack of research today. We're pulling from a comprehensive guide on selecting trustees. It's titled Trustees, Selecting the Guardians of Your Family Legacy. And we're also looking at the methodology of Lumke Sturman,
Who's a trust consultant specializing in exactly this, shielding business empires.
Right. And the mission for this deep dive is sort of twofold. First, we need to explain why, if you are generating serious income in South Africa, having a trust is effectively, well, non-negotiable.
A no-brainer, as the sources say.
A no-brainer. But, and this is a massive but that people often ignore, we also need to look at why the specific people you choose to run that trust can either be your saviors or the ones who burn the fortress to the ground.
That's the human element. It's critical.
Let's start with the why, because I think there's a misconception that trusts are just for the ultra-wealthy, the people with yachts and private islands.
Definitely.
People think, I run a successful consultancy or a construction firm. I don't need some complex legal structure. What is the danger in that thinking?
The danger lies in being what we call the exposed entrepreneur. Think about the typical trajectory of a business owner in South Africa. You start a pleadie, LTD. You're excited. You need a lease for your premises.
The landlord wants a personal surety.
Exactly. You need an overdraft. The bank wants a personal surety.
So even though you have a company which is supposed to be...
It is supposed to be separate, yeah.
You've just signed your personal name to the risk. You're tethered to it.
Completely. And then it gets messier. As the business makes money, you start buying assets. Maybe you buy the commercial property the business operates from. Maybe a fleet of backies. But often, just for convenience, those assets are either put in your personal name or they're sitting right inside the trading company.
Sitting right next to the risk.
Precisely. It's like storing your gold bars in the same room where you juggle flaming torches. If a creditor sues the company, or a project goes belly up, or SARS does an aggressive audit and freezes the accounts.
Everything in that room is up for grabs.
Everything. Your house, your savings, the business assets, it's all one big pot of liability.
That is a terrifying image. So the fortress concept is about breaking that connection.
Correct. The core philosophy here is simple. Separate ownership from risk.
Walk us through the mechanics of that, because to the average person, separating ownership sounds a bit abstract.
It's a change in geometry. You, personally, should own very little. You want to be a man of straw on paper. So if someone sues you personally, there's nothing to take.
That sounds a little suspicious, like you're hiding things.
It's not about hiding. It's about legal structure. This is standard risk management. The trading company carries the risk. That's where the lawsuits happen. That's where the operations are. But the trading company doesn't own the valuable assets.
The trust owns the assets.
The trust owns the assets. So if the trading company goes down,
The assets are safe.
the assets are safe in the trust. Creditors of the company generally cannot touch them because they are legally separate entities.
Yeah.
As the saying in the industry goes, your business protects your income, but a trust protects your wealth.
Okay, that makes a lot of sense. That's the shield against the outside world. But I imagine there are other benefits, right, besides just not getting sued. What about when you die?
That's the other massive pillar, continuity.
Yeah.
If you own everything personally and you get hit by a bus, your assets are frozen. They're locked in a deceased estate.
And in South Africa, winding up an estate is not a quick process.
Not at all. It can take months, sometimes years. And in the meantime,
Your family might not have access to cash. Bank accounts are frozen.
it's a logistical nightmare during a time of immense grief. But a trust doesn't die. It's an entity that exists in perpetuity. If you pass away, the trust continues. The assets are immediately accessible to the beneficiaries. There's no freeze. It's seamless.
That brings us to the elephant in the room. Taxes.
Ah, yes.
I feel like everyone has an uncle at a Bri who says, put it in a trust, you'll pay zero tax. But when I looked at our source material, the numbers suggest the absolute opposite.
That uncle is giving you very dangerous advice. If you look at the raw numbers, the South African tax law is actually quite hostile to trusts if you don't manage them actively.
Hostile in what way?
Well, income that's retained in a trust, meaning money the trust earns and just keeps in its bank account, is taxed at a flat rate of 45%.
45%. That is the highest marginal rate.
Ouch. You're paying top-tier tax for the very first rand and capital gains tax. The effective rate is 36%. Compare that to the maximum effective rate for individuals, which is 18%.
So if you just treat a trust like a savings account, you are effectively paying a penalty tax on everything.
You are. So why do the experts recommend it? Where's the advantage?
I'm waiting.
It's not a loophole. It's a mechanism called the conduit principle. Think of the trust as a pipe, not a bucket.
Okay, I'm visualizing a pipe.
If the trust earns, say, R100,000, and it keeps it, it pays that 45% tax. But the trustees can decide to distribute that R100,000 to a beneficiary. Let's say your daughter who's at university and has very little other income.
And then who pays the tax?
The daughter pays the tax, but at her personal income tax rate. If she has no other income, that rate might be 18% or even zero, depending on the rebates. The trust acts as a conduit.
I see. So the trust itself pays nothing, and the family pays significantly less overall because you're using the lower tax brackets of the beneficiaries.
Exactly. It flows through. This allows for incredibly flexible tax planning for a family. You can balance the tax burden across all the beneficiaries, but again, this requires active management. You can't just set it and forget it.
Right, so it's an active tool. Now, before I move on, I want to clarify some terminology. The sources mention different types of trusts. We're focusing on inter vivos trusts, right?
Yes. Inter vivos is Latin for between the living. It's a trust you set up right now while you are alive. That is your fortress. The other kind is a testamentary trust, which only gets created by your will when you die.
That's the one usually set up to look after minor kids.
Correct. A testamentary trust is great for protecting your kid's inheritance if you die young, but it does absolutely nothing for you while you are alive. It offers zero asset protection today. For business owners, you need a living trust.
Okay, so we've built the structure, we have the fortress, we've got the walls, the moat, the drawbridge. But now we get to the part that really stood out to me in the research. The human element.
The who?
The sources are so clear on this. A trust is just a piece of paper without the people running it. You can have the best deed in the world, but if you have the wrong trustees, you're doomed.
This is where the majority of trust failures happen. People spend a fortune on the legal setup and then treat the appointment of trustees as an afterthought. They appoint their spouse, their brother-in-law.
Their best friend from high school, because they trust them. It feels intuitive. I trust my brother, so he should be my trustee.
It feels safe, but it's often a trap. Being a trustee is not an honorary title. It's a job. It carries fiduciary duty, which is the highest standard of care in our law. If a trustee is negligent, they can be held personally liable for the losses. They are playing with live ammunition.
The source material has some case studies that are honestly terrifying. Let's talk about the Morgan family. This one really illustrates that nice guy trap.
The Morgan family, yes. So Elizabeth and Richard set up a trust. They needed a third trustee, so Elizabeth asked her brother, Thomas.
Thomas the nice guy.
Charming guy, the family favorite. But Thomas had a spotty financial history. A few failed ventures. Nobody saw much of it. I mean, it's just a formality, right?
Fatal mistake.
When Richard, the husband, passed away, the dynamic shifted. Thomas realized he had control. He started funneling trust business to his own struggling companies. He was extracting exorbitant consulting fees. He basically treated the trust like his personal piggy bank.
But surely Elizabeth could just fire him. It's her family's money.
That's the problem. Removing a trustee who doesn't want to leave is incredibly difficult and expensive. You usually have to go to the high court. The family spent years and a small fortune in legal fees just to get him out. By then, the damage was done.
And all because they prioritized family obligation over actual competence.
Exactly. They let the fox into the henhouse because he was related to the hen.
But it's not always malicious, is it? There was another example, the Williams family. No one stole anything, but it was still a disaster.
The Williams case is arguably more common. They appointed smart people, a successful surgeon, and a high-flying corporate executive.
On paper, that sounds like a dream team. High IQ, successful.
But high IQ doesn't mean high availability. The surgeon was working 80-hour weeks, the executive was constantly traveling, the trust just drifted.
What does drift look like in practice?
It looks like investment opportunities missed because nobody signed the documents in time. It looks like tax returns filed late, incurring penalties from SARS. The assets just deteriorated, not because of theft, but because of pure neglect. They were simply too busy.
So what are the actual criteria then? If I can't pick my brother and I can't pick the busy surgeon, who do I pick?
You need what I'd call the holy trinity of trustee traits: integrity, financial literacy, and availability. You need someone who understands a balance sheet, someone who is honest when no one is looking, and, crucially, someone who actually picks up the phone.
That brings us to the most sensitive part of this discussion, family dynamics, specifically spouses. The default is almost always, I'll appoint my husband or wife.
It is the default. And when things are good, it's fine. But the Harrison example in the research serves as a massive warning about what happens when a marriage ends.
This was the rental property nightmare, right?
Yes. Husband and wife, both trustees. They get divorced, it's acrimonious. But they are still legally the joint decision makers for the trust that holds their wealth. They couldn't stand to be in the same room.
So the trust suffered.
They gridlocked. They couldn't agree on essential repairs for a commercial property owned by the trust. The roof leaked, tenants moved out, the income stream just dried up. They were so busy fighting each other that they destroyed the asset they were fighting over.
That is just tragic. So is the recommendation not to appoint a spouse?
Not necessarily.
Yeah.
But you must have a mechanism for conflict resolution. You need an independent trustee who can break a tie or a clause in the deed that dictates what happens if there's a separation. You cannot rely on, "we'll always be friends."
Then there's the kids. I feel like every parent wants to be fair. I have 3 kids, so I'll make all 3 of them trustees.
And that is usually a terrible idea. Trusteeship is not an entitlement, it's a responsibility. If you appoint based on fairness rather than capability, you are setting them up to fail.
There was a gold standard example in the research, the Campbell family. I absolutely loved this approach. It felt like a corporate governance strategy applied to a family.
It was brilliant. The father, David, refused to just hand trusteeship to his kids when they turned 18. He set strict qualification criteria in the trust deed itself.
What were the hurdles?
To become a trustee, you had to be at least 30 years old, have a tertiary qualification, and have 5 years of work experience outside the family business.
That is a high bar.
It is. But look at the result. His daughter, Emma, qualified at 32. She had an MBA. She was mature. She was ready. His son, James, well, James had a rough 20s. Substance abuse issues, financial instability.
If he had been a trustee at 21, he could have wrecked everything.
He would have had access to the control room while he was spiraling. But because of the criteria, he had to wait. He eventually got clean, got his life together, and joined the trust at 38. The rules protected the trust from him, and frankly, they protected him from himself.
That is such a key insight. We often think giving our kids control is a gift, but sometimes it's a burden they just aren't ready for.
Absolutely. And we haven't even touched on sibling rivalry. The Peterson example showed 2 brothers, one a conservative banker, one a risk-taking entrepreneur. They deadlocked on every investment decision and eventually stopped speaking. Without an independent voice, family dinners become board meetings from hell.
Speaking of the independent voice, this leads us to the professional side of things. I noticed in the source material from Limke Sturman that having an independent trustee isn't just a nice to have in South Africa, it's actually a compliance issue.
Yes, this is critical. In South Africa, the Master of the High Court and SARS are very focused on what they call sham trusts or alter ego trusts.
Alter ego. So that sounds like the founder is just pretending the trust is separate.
Exactly. If you, the founder, have total control, if you can veto everything, fire trustees at will, make every decision alone, then SARS looks right through the trust. They say, this isn't a trust, this is just you. And they tax you personally.
So the independent trustee is basically there to prove it's real.
Correct. You need an outsider who isn't related to you, who has no financial interest in the trust, to sign off on decisions. It proves that there's independent oversight. It's your compliance shield.
This is where Limke Sturman comes in. Her website describes her as a trust consultant. How is that different from just walking into a law firm and saying, draft me a trust?
A lawyer is a technician. They will draft the deed, and that's important. But a consultant like Limke acts more like an architect. She focuses on the holistic strategy. She talks about foundation audits and fortress reviews.
What does a foundation audit actually look like?
It's a risk assessment before you build. She looks at your personal exposure versus your business exposure. But she also looks at the how. How do we get assets into the trust?
I assumed you just give them to the trust.
If you donate assets, you get hit with donations tax at 20%. So you generally have to sell the assets to the trust. But the trust has no money, so it owes you. That creates a loan account. And then you have Section 7C of the Income Tax Act to worry about, which can tax the interest on that loan.
Okay, my head is spinning now. This is why people avoid this stuff.
And that is exactly why you need a consultant. Mechanics are complex. You need someone to navigate Section 7C, someone to handle the CIPC compliance, someone to make sure the fortress actually has walls.
I noticed her wait list is for business owners with turnover between R1 million and R50 million. That feels like a very specific and maybe underserved demographic.
It is. Below R1 million, a complex trust might be overkill. Above R50 million, you probably have a massive family office with a full-time CFO. But that R1 meter to R50 meter range, those are the people who have built significant wealth but are often completely exposed. They're the ones with the house on the sand.
And looking at her methodology, her focus seems to be on education, empowering the client to really understand the jargon.
Which is vital. You cannot outsource your legacy entirely. You need to understand the basic mechanics of your own fortress. She helps clients feel empowered, not confused, which is a breath of fresh air in the financial world.
I want to close with one final scenario. The bus factor. We talked about death, but what about the business itself?
This is the ultimate test. If you are the business and you die, does the business die with you?
There was a great example of how to handle this with the Anderson family. Robert Anderson ran a manufacturing business.
This is a classic dilemma. He had a daughter, Sarah, who worked in the factory. She was the successor. But he also had a son, Michael, who was a doctor and had zero interest in manufacturing.
If you leave the shares equally to them, you just create a war. Sarah does all the work, but Michael wants half the profits.
Precisely. So Robert structured the trusteeship very carefully. Sarah was made a trustee to handle the day-to-day business decisions. But he appointed an independent trustee specifically to protect Michael's financial interests.
So Sarah couldn't just hoard all the cash in the company.
No, she had to declare dividends. But crucially, Michael couldn't tell Sarah how to run the factory. It separated the management of the business from the benefit of the wealth. It prevented a feud and kept the business running.
That is such smart structuring. It highlights that you have to design the trust for the specific people involved. You can't just copy-paste a template.
And it highlights the paradox of the trust. To gain protection, you have to let go of absolute control. If you try to rule from the grays or if you try to be the dictator while you're alive, the structure fails. You have to trust the trust.
So bringing this all together, we started with that fear of the Tuesday morning lockout. We've seen the solution, the fortress, separate risk from ownership.
And we've seen that the tax pain is manageable if you use the conduit principle correctly.
But most importantly, we've learned that the who is just as important as the what. You can't just pick family members because it's convenient. You need integrity, competence, and independence.
And if you don't have those people in your immediate circle, you need to hire them. It's really that simple.
If this all sounds overwhelming, and let's be honest, the tax stuff alone is heavy, that is where professional help comes in. Limca Sturman seems to be a fantastic resource for this specific challenge.
I'd say her foundation audit is the best first step. Stop guessing. Get a professional to look at your risk profile before the storm hits.
You can find her at www.limcasturman.com. Even just browsing the site is an education in itself on how these structures should work.
Highly recommended. It's about moving from anxiety to assurance.
I want to leave you with a thought today. It's a bit of a provocative one. If you were sued tomorrow morning, served with papers at 9 a.m., would you still own your business by 5 p.m.? Or would your creditors?
And if you weren't around to answer that door, are the people you've chosen to hold the keys actually capable of protecting what you built? Or have you just set them up for a family feud?
Heavy questions, but better to ask them now while you can still change the answers. Thanks for listening to this deep dive. Go build your fortress.
And build it on solid ground.
Exactly. Catch you on the next one.